You will never see a high school dropout step into an operating room and perform better heart surgery than a trained doctor. You won't see an amateur build a safer, more efficient rocket than an aerospace engineer. Finance offers a rare environment where people with zero education or formal training can, and frequently do, outperform professionals with Ivy League degrees. Take a tech executive who helped invent part of Wi-Fi technology. He made millions for multiple companies and possessed a massive, highly capable intellect. His relationship with money was entirely childish. One day, he handed a colleague several $1,000s in cash to buy gold coins. When the coins arrived, he and his friends took them down to the Pacific Ocean, skipping them like rocks across the water just for fun. Today, that tech executive is completely broke. Contrast his life with a man named Ronald Read. Read was a humble janitor who never made more than minimum wage. He drove a rusty truck, wore old clothes, and quietly saved and invested small amounts of cash his entire adult life. When Read died, he left behind $8 million in the bank. Financial success relies on human behavior and self-control, areas of psychology that don't follow the clean, predictable laws of a hard science like physics. When you see someone driving a Ferrari down the street, your first instinct is rarely to admire the driver. You actually picture yourself behind the wheel. The person who bought that car did it thinking observers would admire them, but people just use the car to fuel their own fantasies. The driver is completely invisible. This chart illustrates the trap of fake wealth. We judge wealth by what people show us, like a $100,000 vehicle or an expensive watch. But spending money to show people how much money you have usually results in expensive debt, draining their accounts down to zero. Real wealth is invisible. As the urge for ego spending shrinks, that money flows into the background, growing quietly. Wealth consists of the cars not purchased, the upgrades declined, and the assets compounding over time without drawing any attention. The janitor won because he separated his ego from his income. Building actual wealth relies on the remarkably simple act of spending less money than you earn. Getting money and keeping money require completely opposite psychological skills. Jesse Livermore made the modern equivalent of $3 billion in a single day during the 1929 stock market crash. Getting money requires optimism and taking on intense risk. But just 4 years later, lacking the humility and fear required to protect those massive gains, he lost every cent. Warren Buffett is the master of keeping money. He is widely considered the greatest investor in history, but his true advantage is time. Out of his $84 billion net worth, roughly $81.5 billion came after his 65th birthday. Looking at this chart tracking his net worth over time, you can see the math at work. The line remains relatively flat for decades. Buffett reached these figures by staying invested for an entire lifetime, allowing his returns to compound and curve upward exponentially. If the math is so reliable, why doesn't everyone do this? Because that exponential growth has a steep psychological fee. To reach it, you have to endure terrifying market volatility and watch your portfolio's value drop wildly along the way. This marquee displays the harsh reality of historical crashes, like the Lehman failure. True investors do not panic when they see warnings like this. They accept losses and market drops as the regular cost of admission to stay in the game. Long-term success relies entirely on surviving the bad times without liquidating your assets. If you can simply avoid panicking, your money has the time it needs to compound. Money offers a utility that often goes overlooked: absolute control over your time. The highest dividend money pays is the freedom to wake up every morning and dictate exactly what you want to do with your day, completely free from forced obligations. To reach that point, you have to adopt a few simple habits. First, lower your spending and automate your savings. A dollar saved is essentially a raise that never gets taxed. Second, build a strict margin of safety. The world is wildly unpredictable. Keeping a boring reserve of cash as an emergency fund protects you from bad luck and prevents you from selling investments when things break down. Third, ignore the endless cycle of financial news. The media thrives on panic because bad news gets clicks. Over the long run, consistent optimism is what actually builds wealth. You also need to block out the noise from those around you. Taking investment advice from a day trader when you are trying to build a decades-long retirement portfolio is a recipe for disaster. Stop listening to people playing a completely different money game than you are. If you are serious about fixing your finances, stop searching for complex mathematical formulas. Look in the mirror and fix your daily behaviors. You don't need a genius-level intellect to win with money. You just need to act a lot more like the janitor.